So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statement? I will go step by step, including valuations when we get to that point, in how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Now, to their business model and their operations, how they operate things. So they operate derivative OTC markets. This is one of the registry services, depository and registry services for debt securities and cash transactions. Essentially what that means, to my understanding, is they make sure people get the right stocks when they buy, and when they sell, they get rid of them, and all the paperwork is aligned, all these kind of things. This is listing new companies on the ASX. This is the trading markets or trading services they offer. Post-trade services, again, making sure all the paperwork is correct, all the shares are where they're supposed to be, those kind of things. Clearing, same thing. Settlement, same thing. And if anybody out there is an expert in trading, and I'm kind of getting these terms a little bit mixed up, let me know in the comments below, because frankly, I don't like trading whatsoever. I don't care about trading whatsoever. So in this case, it's important because the business runs on trading, and that's how they make a good chunk of their money. But just the terminology and stuff, frankly, it's kind of in my opinion, because frankly, I don't care about trading. My eyes just kind of glaze over when I read about this kind of stuff. Okay, so this is important. So they produced off of operating revenue of 764 million, I'm assuming AUD, Australian dollars. They produced an EBIT of 537 million in fiscal year 2017. So their operating margin is, let's see, I'm guessing that. %, which is spectacular. I look for anything over 10% on a consistent basis. So that's spectacular. Again, earnings per share, don't really care about. Dividends, they pay out 90% of their dividends, which, I mean, they pretty much have to. There's nothing, they can't use a giant chunk of this money to continue to reinvest, because there's not, frankly, much, to my knowledge, you can reinvest to gain an advantage over there in this business. So they pay about 90% of the dividends to shareholders. Okay, and this is important. This is the kind of breakdown of where they make their revenue. So there are 5 main categories: listings, issuer services, derivatives and OTC markets, trading services, equity post trades, and other revenue. So let's go down to this one. So here's the 4 kind of main ones right here, and then they break it down further from there, where that money comes from. So a good chunk of their money comes from listings, futures and OTC clearing, and the rest is just kind of spread out pretty evenly. So what does seeing something like this mean to me? To me, this means they should focus more on this area and this area, growing these things. Focus less on this. This is only 3% of the revenue. Don't know if they could focus less on this, because cash market trading, that seems pretty important to me from my understanding. Issuer services, that's probably helping people who list, so I don't think you can really get rid of that. This, again, is a clearing service, can't really get rid of that. So these things, I would maybe cut this. But again, there's not much room to improve these things, in my opinion, to my understanding of the company up to this point. Okay, so And this, they just break down and they get, again, super granular here with their listing revenue. They break it down to how much it was up, how much it kind of brought in based on, and they go back, or they start at the top and then they go down from there. So this is all super important information. This is all my notes. Again, if you want to read this, I will link the annual report. The annual report is linked, if I remember correctly, in the first video case study of this. If not, I will link it below somewhere in with this video, so you can read through all this by yourself. But I'm going to link the notes that I took as well to this video. Again, derivatives market, OTC markets, 269 million. Again, this is, I'm going to scan through all this because it's all important information, but frankly, there wasn't anything super important in here. Generally, it's all pretty much going up over time, which is good. Operating expenses, nothing really major of note or major problems here. Of course, you should expect this to typically go up over time, especially, this is especially not that big of a deal because the company produces such gigantic margins that if they go up by less than, what is that, 10, so less than 10%, that's not a big deal. CapEx, this is reasonably important because they have to continually invest in new and better technologies. Dividend income, self-explanatory. Okay, here we go. So this is what all this gigantic cash flow means. They have $9 billion in cash and available for sale financial assets. This is not cash they can necessarily use all of it, because this, to my understanding, again, we haven't finished this financial statement, but to my understanding up to this point, is this is money that they have to kind of have available for issues. Make sure clearings go properly. Make sure things essentially stay working well, to my understanding. Tangibles excluding software, that's brand names, typically investments in other companies. They talk about that below. Other assets, that's the financial assets, or financial notes. We haven't got to that yet. This, there's a note down here on this. So this is important. So okay, so this is important. This is something I put in the things to note and highlighted, because this is essentially money. What was that? $8 billion worth of money they are keeping on hand, again, to keep kind of discrepancies low. If there's any problems, they'll kind of make up the difference. It's, again, collateral lodged by participants to cover cash market and derivatives exposure cleared through its licensed CCPs. So what essentially that means, again, I haven't finished this report. To my understanding, what this means is if there's a problem with one of their participants, which is an issuer in this point, one of their companies listed on the ASX, they will use this collateral from these companies to kind of make up the difference, make sure there's no issues, and kind of try to fix the issue. That's, again, to my understanding. Okay, so these business strategies and prospects, these are just talking about how they're going to try to keep a technical advantage, how they're going to be working to get a technical advantage. Frankly, I don't know why these are so long, because these, I mean, there's only so much this company can do to grow. There's only a certain amount of companies in Australia that want to list only in Australia. Most companies, if they're big enough, want to list on U.S. stock exchanges because they're the biggest, most traded stock exchanges in the world. So unless that changes any time in the next 30, 40 years, there's only there's kind of a cap on how big this company can get, and how big the Australian stock exchange can get. There's also, you have to compete with not only U.S. stock markets, but if you have a company that's in that area, let's say Indonesia, I believe they have their own stock market. I know Japan has their own stock market. Philippines has their own stock market. Vietnam has their own stock market. Thailand has their own stock market. So there's all these other stock markets around the world and countries as well in kind of this area that this company has to compete with. So there's it kind of puts a cap on the size this company can grow to. Engagement with one's clients is, let's talk to clients to make them feel better so they list with us, is pretty much what that entire thing is. This is generally, just kind of common sense stuff. We are attuned, or we are based on, a lot of our economic value is based off the overall economic value in Australia and how well the stock exchange runs, regulations, changes to regulations, licenses. There were some important things in here on the licenses about how they are pretty much the only ones licensed in Australia to run a stock exchange, at least at this level. So that's important for competitive advantage information. But a lot of these are just kind of basic knowledge, common sense knowledge. Director's report. Of course, the directors think they're doing a great job because they're paying themselves so well. Same thing. Auditor thinks they're doing a great job and they have to sign this to cover their butts in case they get, or so they can't get sued. And then we're to here. So again, I'm not going to go through all these notes. This video is already longer than most of these videos I do. So I will link these notes below this video so you can download them up to this point and see where my notes are. I talked about the major points in here. Highlighted the major notes again. Talked about this, told you why this is important. So all these are noted if you're kind of following along of what I consider important things. So if you want to see all this, make sure to get those for free below this, and you don't have to put your email in. You can just download them right from the website, or if you're on our site, valueinvestingjourney.com, on our blog, or if you're on YouTube, I'll link it there as well. I'll put the link there as well. So up to this point, the company still looks fantastic. There are more things that they're not necessarily risks, but they're more of annoyances to me. We talked about those, the director and executive compensation, those kind of things, the complexity of their performance and remuneration, those kind of things. Again, they're not necessarily major issues, major red flags at this point, but they're more of an annoyance at this point. If I continue to find major issues, then this, or if I find other major issues, that kind of might set my thinking to maybe this is too risky of a company, but that's still going to be determined. We still got half of the financial reports to go, and frankly, we haven't even hit some of the important stuff, or most of the important stuff yet, in my opinion. The financial notes, which we're just getting to now, and the financial reports are my, frankly, favorite parts to read, because most people don't like reading footnotes, but that's, in my opinion, the most important parts to read. We're not even to that point yet. So still an open debate on whether this company will be a good investment at this point. If you have any questions, comments, concerns, let me know in the comments below. If you're watching on YouTube, make sure to subscribe and hit the bell so you're notified anytime we release a new video. This is the third video on this company specifically, third or fourth, and I believe it's the 10th or 11th in our case study series. So make sure, if you want to watch those other videos, they will be in a playlist on YouTube. If you want to see our other videos where we talk about all sorts of other stuff, value investing, finance, learning, how to learn better, book reviews, anything like that, make sure to check out our other playlists. We have, I think, 7 playlists at this point. We're adding more as we need to. So make sure to watch those other videos to learn a ton.